Thanks everyone for joining us today. My name is Dean Stange. I'm a senior financial advisor and a principal in our Madison, Wisconsin office. Joining me today is Raffia Hassan, our chief investment officer and a principal in our Chicago, Illinois office. Say hello to everyone, Raffia.
Hi, everybody.
We'll be hearing a lot more from Raffia in just a couple of minutes. Our goal today is to try to get many of the questions that have been asked about the recent volatility in the world markets. As we all know, the world stock markets have had a steep decline the last few weeks due to the coronavirus. While the full impact of the virus is not yet known, it is important to keep in mind that the stock and bond markets have been through similar unexpected events before, such as 9/11 and the 2007 to 2009 Great Recession, and eventually they did recover to new highs. In fact, the US stock market had hit record highs just as recently as February 19th. That seems like the good old days now, just a month ago. While there's a lot of uncertainty right now and likely continued above average volatility for some time, history does tell us that markets should eventually recover. And we'll break down that history for you in a bit. We also want to discuss how to get through this from an emotional perspective. And again, we'll touch on that in a few minutes. With all that somber news, Raffia, I feel like we need some good news, as small as it may be. Spring is here officially today, so we did make it through another winter. And take it for what it's worth, China today also reported no new coronavirus cases for the first time since all of this started. So maybe there's a little light at the end of the tunnel there. We did receive a lot of great questions from everyone. We thank you for that, as it has helped us make sure we are addressing the right topics. Many of the questions hit some major themes, so we're going to start there with those main themes, and then we will add in some additional questions that we have received as well. A couple of quick ground rules for this recording. First, we were not able to provide any advice for any one specific situation that they might have asked about, given the general nature of this format. If anyone has specific questions about your personal situation, please contact your Wipfli financial advisor. Second, we are not doctors. We don't play doctors on TV, and we won't try to play one here. So we won't provide any commentary about the virus itself or how long its effects may last. With that, let's jump to our first question. Raffia, many questions from folks that we have received ask this question in a number of different ways, but essentially people are asking, how long do you think the stock market will recover? And ultimately, how long are stocks going to be down here in a depressed manner?
Sure, Dean. So first off, I'll say we can't make predictions as to how long this particular event, the coronavirus-related event, will last. But we can look to previous market shocks to provide us a guide and provide us historical context around how markets have performed in previous crisis situations when we have seen the type of bear market drop. And a bear market drop is a drop of 20% from peak to trough. And so we can look at some of that historical context to give us an idea of what it's looked like in the past when we've had these types of situations occur. So if we turn to the next slide, what you see on this graphical representation is bull and bear markets for the S&P 500 index going back to 1926. And you can see the bear markets are in red. And what you see is that there's actually been 8 bear markets over that time period going back to 1926. And the one that's most fresh in many of our minds is probably the Great Financial Crisis. And that one lasted 16 months. And from peak to trough, the market was down about 51%. And, you'll remember during that time period, people were really concerned. And there's a lot of things that are happening today that kind of remind me of what it was like during the Great Financial Crisis, when there was a lot of uncertainty in the market. We were hearing news about banks crashing, and there was, a lot of concern around what was going to happen with the financial system, and was the financial system going to collapse? And so that was a very traumatic time for investors. Another one of the bear markets that was much shorter, and on the shorter end of the spectrum, was the bear market of 1987. That was the time of Black Monday, that particular bear market ended up lasting just 3 months. So on the short end, we're seeing 3 months. On the longer end, we're seeing more months than that. So there can be a range when it comes to the time frame. But to me, the biggest takeaway when you're looking at this chart here is that The bull markets tend to last longer and provide stronger returns, and that's why you stick it out in the bear markets. And here we're only looking at the S&P 500 index, which is an index of US large cap stocks, but most investors and the vast majority of our clients hold bonds within their portfolio. And what we've seen in prior historical bond periods is that bonds do tend to provide stability through market troughs. And so from a recovery standpoint in a portfolio, it's probably more instructive to look at a more well-diversified portfolio. The one that we're looking at in this chart here is a 60-40 portfolio that includes both US and international stocks, as well as 40% in investment grade bonds. And you can see how this chart, on this chart, how that type of portfolio performed coming out of some recent crises events. So if you look at the financial crisis time period and the collapse of Lehman Brothers, and many of us probably remember when that happened back in September of 2008, a 60-40 portfolio was actually slightly positive, up 4% just 1 year later after that big crisis event. And after 3 years, the return on that portfolio was 12%. And then 5 years, that portfolio was up 47%. So I wish we could say with some certainty how long this will last, but we do know that markets have been able to overcome some pretty turbulent times in the past, and that gives us some comfort in the situation that we're in today.
Raffia, one point I want to make here is for all of our listeners really to keep in mind that for every one of the billions of market transactions over this time period where the markets are going down, there is a buyer for every seller. It's not just sellers dumping stocks. Someone is also on the other side of that transaction buying them. Those buyers believe the price is now at a point where they can profit over time. Now, maybe they're buying simply because they have a much longer holding period and they're willing to wait for the price to come back up, but they are certainly not buying stocks with the intent that that stock is going to go down. So what's really happening right now with all this uncertainty with the stock prices is that there is such a wide range of possible outcomes depending upon ultimately, government stimulus and what the Fed does and obviously how long the virus sticks around. So we have to understand that markets are built to price in all available information. So it's true that if the economy is disrupted, then growth and profits and cash flows may fall. And that is the significant uncertainty right now, which makes it difficult to investors, for investors, to assign a value to investment assets. So that's why we're seeing these big swings in the market, as it's trying to price in all this new available information with all the uncertainty. In simple terms, for an investor, it's hard to know what to pay today for a share of stock in a company to receive $1 of profits in the future, because it's so unclear what that future may look like. So as the market starts to get some clarity around the economy and corporate profits, we would expect the markets to begin to rebound and potentially very quickly. Rafi, let's move on to... Sorry, go ahead.
Oh, I was going to say, that's a great point.
Okay, let's move on to another series of questions that we've gotten, again, all around the issue of possibly a recession, or at this point, really probably, probable recession. What would you say to those who feel that this event is different from recent bear markets? Wouldn't it be better to switch to a more conservative portfolio if we know a recession is imminent?
So first off, I want to say, yes, absolutely. A lot of people are talking about a recession, and, that's a very real risk. And the things that, we're doing in the economy today to avert the health crisis of coronavirus is causing us to have an economic downturn. So that's something that's very real. We're almost done with the first quarter. And so the impact of that, we're not really going to see it in the first quarter GDP number, or if there is an impact, it'll be relatively less. The real impact that, what we're seeing many people talk about is likely to be felt in the second quarter. And some of the estimates range from as much as a 2% to a 5% decline in second quarter GDP, with expectations that, in the second half of the year, the GDP should start to recover. And, some of of the economic hurt that's going to be felt can be averted with the monetary and fiscal measures that are currently in the works to combat the recession. And there's many of them that have happened on the monetary policy side. The Fed dropped the policy rate to 0 to 25 basis point range. They announced $700 billion of quantitative easing, which is the same amount of quantitative easing which was announced at the very beginning of the financial crisis. The Federal Reserve has also said it's going to start making loans to American corporations, relaunching kind of a financial crisis era commercial paper tool to help calm short-term debt markets. And so these are all actions that are being taken to really improve liquidity within the financial system and also get credit markets functioning again. And then on the government stimulus side, which is probably things that people are more attuned to, and the average an individual is going to benefit from. Yesterday, the president signed a bill that provides free testing for coronavirus infection. It also required smaller employers to provide at least 2 weeks of paid sick leave to those people who will be affected by the crisis. It increased Medicare funding, expands unemployment insurance. So a lot of positives there. The White House is also seeking a stimulus package estimated at $1 trillion, and that includes a plan to send checks directly to Americans. The amount of those checks is expected to be around $3,000, and there's going to be 2 tranches of $250 billion going out in direct cash payments if the stimulus package is approved. There's also some direct assistance within that stimulus package for the airline industry, which has been hit pretty hard by the outbreak, and up to $500 billion to boost small businesses. And so that total size of that stimulus package that's being proposed is $1 trillion. Compare that to the total size of the proposed stimulus package that was passed in 2009 in the midst of the financial crisis, which is $787 billion. So the size of the stimulus package is actually bigger than the one that eventually got passed during the financial crisis. So there's a lot of positive things that are happening from a government stimulus standpoint, from a monetary easing standpoint, that should help to combat some of those recession risks that are certainly out there in the market. And the stock market is taking in all of this information and pricing it in real time. So as you said previously, we don't have clarity on the depth of the recession, and we know there will be some type of slowdown, but we don't know how bad it's going to be. And one of the reasons for that is that a lot of the economic indicators that come out, like GDP numbers or even jobless claims or unemployment numbers, those are all lagging indicators of what's going on in the economy. We don't get those numbers out until after something has already happened. Whereas the stock market is pricing in all of these things real time, and so it's seen as a leading indicator of the economy. And so, if we turn to this next slide here, you can see how resilient markets have been through past recessions, and that they've actually really ended up rewarding investors for the capital that they have risked through recessions. Well, you do see the market here is the S&P 500 index that we're showing here. It goes down in periods of recession, but then the recovery has been much greater in those historical events that have taken place from a recession standpoint.
I think a good example of markets being a leading indicator was really the Great Recession, where the stock market bottomed in March of 2009, but the recession wasn't declared over until June of 2009, and unemployment didn't hit its peak until October 2009.
Yeah, absolutely. So you see that data point actually on this chart as the very last gray shaded bar, which is the last recession that we were in, and you can see the stock market decline to its lowest point kind of well before we were fully out of that recession.
Rafi, what about sectors of the market that we're hearing that maybe hit the hardest in this downturn, like airlines, hotels, oil and gas industries? Some questions that we're getting around, why not sell that exposure in the portfolio now to better position it to withstand possible further decline?
Well, Dean, I mean, it's a great question. I understand where it's coming from. One of the benefits of owning a well-diversified portfolio of stocks is that it spreads your risk across multiple different sectors of the market. Our typical client portfolios have about 6% exposure to the energy sector. Those numbers are as of the end of February. I'm sure that number has gone down slightly since that time. And so we don't know how much is already priced in when we're looking at the price of a stock, and how much of that bad news regarding what's going to happen with some of these industries that we're hearing are going to be hardest hit is already priced into the stock prices of those companies. And a great example of that, again, going back to the financial crisis, is financial stocks. The ones that ended up surviving through that crisis were some of the best performers in the recovery. And so it's very difficult to predict who the winners and losers will be, which is why, you know, having a really well-diversified portfolio that includes exposure across sectors and companies is really key, particularly when you're going through these types of crisis events.
Well, I think there's a lot of data now that shows that humans are really just plain terrible at predicting the future. I think that's something that we do know. Much less trying to predict all the variables that go into the economy, company performance, stock price. The evidence is pretty clear that trying to pick individual stock sectors or individual stocks that will outperform the markets is nearly impossible, particularly over longer periods of time. So that's why we don't recommend, trying to pick winners at this point of the cycle. Rafi, another type of question we received is around the portfolios that we're managing. So the question is, what is Wipfli Financial doing for clients in the current environment? How are we helping clients manage their portfolios through this?
Right. So first off, when we build financial plans for clients, we build them knowing that these types of market events will happen. And that goes back to why we start with, what are our clients' needs? What are their objectives? And tying that into the financial plan and building an allocation that we think that they will be able to, assessing their risk tolerance, so that we come to an allocation that they feel that they will be able to live with through a period like this, and that's going to be able to stand the test of time even through these difficult periods. And that's why it's really important to have bonds within the portfolio, because bonds do provide stability within the portfolio. And we have seen kind of more recently in the past few weeks, some of the even in investment grade bonds have had some negative returns, but then when you compare that to the negative returns that you've seen in stocks, it's far, far less. So they are still providing stability within the portfolio. The other thing that we've been very proactive in doing, and is a big part of our approach, is tax loss harvesting. So tax loss harvesting is essentially selling a security at a loss and then going back and buying a similar security so that you can maintain the exposure, but you've locked in that loss that you can use to offset gains later on within your portfolio. And during periods of high market volatility, what we see is that when stocks are down, we see that the opportunity to tax loss harvest actually increases during those time periods. And so at the chart that's up on the screen right now, what you're seeing is actually on the x-axis, it shows, on the y-axis, what you're looking on the left-hand side is the tax alpha that is generated on a calendar year-by-year basis in a portfolio that holds the individual stocks that replicate kind of an S&P 500 index strategy. And then on the right-hand side, it's showing how much volatility there is in stocks in the various different time periods that we're looking at. And so what you see is in the period like 2008, 2009, where there was a lot of volatility in those underlying stock holdings within the S&P 500, there was a lot more opportunity to generate tax alpha. And on average, we're looking, at a longer time period here, over 11 years, in this type of portfolio, you were able to generate about 2% of tax alpha. And so that's additional after-tax returns. So when you're talking about pre-tax returns, you're not taking into account the amount that's being paid in taxes, and that can be as much as 2%. So in a strategy of where you're holding the individual stocks that are trying to replicate the performance of the S&P 500 index, by being able to proactively tax loss harvest, you can mitigate some of that, return that you're paying out in taxes. And that's a real added benefit to our clients. And we've been very proactive during this current time frame in taking those tax loss harvesting opportunities. And I'll share some numbers around what we've been doing there for our clients. And then the other thing to note is that this is showing the benefit in a portfolio of individual stocks. This is something that we also do across our clients' accounts that hold mutual funds. And so there's opportunities there as well to be able to provide additional benefits through tax loss harvesting within the portfolio. And this is the ideal time period to really be taking advantage of that strategy of really looking at client portfolios closely to be able to take tax loss harvesting opportunities.
And from a tax standpoint, those losses can be used to offset other gains they might have in the portfolio. They can be used to offset gains that they might have outside if they've sold outside of the portfolio, if they've sold some other assets. And ultimately can be used to offset ordinary income up to $3,000 a year. And those losses don't, you don't have to use them up in a certain time period. They roll forward if you can't use them in any one year. And they can be a very valuable part of overall tax planning, particularly, if there's some upcoming sales that might occur. The other point I'd make about it is it doesn't appear on the performance statement for the portfolio, right? It's something that shows up on a tax return, but you don't see the benefit necessarily on that investment statement.
Absolutely, yes, that's 100% true. All right, so then in addition to that, one of the other things that we're doing very proactively right now at this point in client portfolios is to look to rebalance client portfolios back to their strategic allocation. And so, in periods that we've seen in the past, what that has meant is taking off, because equity markets, stock markets did so well. What rebalancing meant was taking some of the risk off the table and being able to bring the risk profile of the account back onto target. But in this time period, what rebalancing means is selling bonds that have performed relatively better and buying into stocks, which has been performing worse, and bringing your equity target back up to its full level. And the benefit of that is that you're actually buying stocks that are now lower priced that you already had in your portfolio. And so that definitely has an enhancement, adds an enhancement to the returns of a portfolio. And so on the screen here, what we're looking at is a portfolio in black from the course of the first quarter of 2001 to the first quarter of 2019 that doesn't get rebalanced at all. And this is a 60% equity, 40% fixed income portfolio. And it includes the time period of 2008, 2009, which, maybe is somewhat similar to what we're going through today. And you compare that to a portfolio that's rebalanced on an annual basis, and you can see over that time period what the return benefit is, a very real return benefit to the portfolio from having that discipline and rebalancing at that time when it can be hard to do it back into stocks.
So that rebalancing is really a forced discipline, isn't it? Where you are, as you said, you're selling something that's done well, you're buying something that hasn't done as well, but at a much lower price now, particularly stocks, than it was, again, just a month ago. And again, that's that forced discipline to buy low and sell high.
Yep, and it can be difficult in a time like this, right? When you feel like, hey, maybe there's just more bad news coming, and maybe this is, I shouldn't be doing this right now. So it is a difficult thing sometimes for people to reconcile with, but that's where the discipline comes in.
Raffia, you mentioned you were going to comment on some of the activity that we've been doing as a firm for clients in these areas.
Oh, right. So we've been very proactive when it comes to both tax loss harvesting and rebalancing in our portfolios. And even just over the last 5 days, and they've been a very tumultuous 5 days in the market, going up and down, our trading team has placed 15,000 trades across 15,000 plus trades, I should say, across our client accounts to rebalance and tax loss harvest. So it's been something that we've been very focused on in our client portfolios.
We know our trading team, a shout out to them, they've even been working on weekends to get things ready for the following week. Let's move on to emotions. Emotions are such a big part of obviously downturns like this. How do we keep emotions in check so that we don't make, clients don't make, any investor doesn't make a mistake with their portfolio during this kind of market turmoil?
Sure, yeah, so the market has been extremely volatile in this bear market so far. That means we're seeing lots of big down days and big up days as well, all packed in closely together. So on a day like last Friday, you saw the market up almost 10%. Then Monday, it was down 13%. And Tuesday of this week was an up day, and then Wednesday it was down again. And when you focus on these day-to-day movements and your emotions go up and down based on where the market is at and where your portfolio is at from one day to the next, it can really be very easy to lose sight of the big picture and just to be so focused on the emotions around investing that you can get to a point where you might end up making a decision that's detrimental to your long-term financial situation. And that bigger picture is that historically, markets have actually gone up more than they have gone down. And so investors have been rewarded for bearing this type of uncertainty in the market over the long term. And that's something that we see from past historical events, and we've talked about that earlier on. So it is something that, you know, we do need to be mindful of.
Well, as a financial advisor, I'll put my financial advisor hat on here for a minute. You know, we really do try to keep our clients from getting too high or optimistic when things are going well, and certainly too low when things are not going so well. We try to develop an allocation of stocks and bonds that can earn clients an appropriate rate of return when markets are doing well, and that also allows the client to continue to be successful even through this sort of market turmoil. If you are truly investing for the long term, one suggestion that I have that I've had some clients respond to that have found helpful, frankly, is to stop looking at your portfolio gains and losses, particularly in dollar amounts, every day. That can be such an emotional roller coaster for anyone, and it's really that cycle of emotions that's up on the screen, and that's what we really want to avoid. So as easy as it is for me to say this, and as hard as it is to do, I think a lot of us would recommend that folks stop looking at their account values, particularly in the dollar terms, going up and down as much as possible, and let the markets work through this. We certainly don't mean to diminish the pain or anxiety that anyone is feeling by saying that, but patience and discipline are really important emotionally to get through this, and patience and discipline will be rewarded on the other side when the rebound occurs. However, if someone absolutely feels that they need to make some changes in their portfolio, another suggestion would be to do it in incremental small steps. So make small allocation changes in the portfolio, maybe withdraw some cash to have more cash on hand if that's, you know, is going to make you feel a little more secure. These smaller steps will really help people with a sense of some control and hopefully help ward off the feeling of doing something drastic that might really harm a long-term plan, such as wanting to pull everything out and go to cash. Just as importantly here, it's important for investors to review their long-term plan. Our advisors are always standing ready to review clients' long-term plans with them. And you know, we've accounted for these types of occasional significant declines in our long-term growth assumptions in those financial plans. So we can look at the impact of this kind of downturn on those plans, running different scenarios so that our clients can you know, make choices more based on planning rather than emotion.
Yeah.
Moving on, Raffia, Another question that we've received, why not make a switch to more bonds, particularly where the high quality corporate bonds and municipal bonds seem to be holding up better in the current environment?
Yeah, Dean, I know that, this is something that ends up coming up in investors and clients' minds, when these types of events occur. And so, I want to provide you and people who are listening in with just a really an example of what it looks like when you make that switch. So what we're looking at here is the orange line shows a 50% stock, 50% bond portfolio. It starts out in 2007, and then 2007, 2008 financial crisis was when the market started to go down. You can see what happens with that portfolio. The value goes down to close to maybe like $100,000 portfolio goes down to that $70,000 range, and then at that point, at March of 2009, when the market bottomed, if that investor in that 50-50 portfolio changed their allocation to 100% bonds, you see what the impact was. They're barely even when you come to December of 2016 by making that switch to 100% bonds. And even worse, if they go to 100% cash, they're locking in that 28% decline from the peak, from 2017 to the bottom. Now you might say, okay, well, Rafi, that's an extreme example because that's assuming that you make that switch at the absolute worst time, which is March of 2009, just when the market bottoms. But I would say to you, even if you make that change before, even if you are able to avoid some of that negative market movement that comes before the bottom, the impact to your long-term portfolio of making that switch is still going to be very severe. So it might not be that negative 28%, but it might be negative 10% or negative 15%, what have you. And you're not going to end up getting back to that original portfolio value or even participate in a strong recovery that may follow that market bottom.
We hear people sometimes say, well, when things clear, we'll reinvest, or we'll if we've gotten more conservative here because of the downturn, when the smoke clears, we'll reinvest at that point. But the problem is, of course, is that when the rebound comes, no one's ringing a bell at the bottom and saying it's time to reinvest. And there's likely going to be some head fakes when the market starts going back up. And we really saw this in 2009, where the market started to recover a little bit, maybe went up, I don't remember exact amounts, but 10, 15, 20%, and then it went back down and sort of retested those lows. And then when it started to go back up permanently, there were a lot of commentators on TV and pundits saying, oh, this is another head fake, or, we might retest those lows again. And eventually, of course, it just kept going up. So the problem with thinking it's, that you can get back in when the smoke clears is you can only determine where that bottom is or when the rebound started by looking backwards. That's the only way. And by the time you sort of figure that out and you feel safe to get back in, of course, prices may be a lot higher. And maybe to that point, we have a chart in the appendix here. I'm going to go back, Raffia, that shows how reacting and just being out of the market a couple of days can make such an important difference. Can you maybe just real quickly kind of touch on that?
Right. So we're looking at, a chart that shows the performance of the S&P 500 index from 1990 to 2018. So it's a pretty long time period. And across the bottom, you see that the annualized compound return for the entire index over that time period was about 9.3%. Now, if you miss the best day in the market, that return goes down by, about, let's call it, 50 basis points, so 8.87%. But missing the 5, 15 or 25 best days in the market, reduces those returns even further. And so if you miss just the 25 best single days in the market over that entire time period, your return would be cut down to 4% on an annualized basis. So that's how important it is to maintain exposure in the market, because being out of the market on some of those strongest days can really have an impact on your long-term return.
And Raffia, when do we normally see some of these best days?
Some of these best days come around in the most volatile periods. You know,
Right.
that's something that the evidence shows, and it's probably some of the days that we're experiencing right now. And I know some of the positive days are at the, jammed up together with some of the worst days.
Exactly.
So it's
Yep.
a very difficult thing to time.
Another thing that I'm going to go back to where we were here. Another thing that I want to touch on and make sure that folks listening to this really understand is to keep in mind that as investors, we do get paid a higher return owning stocks over time compared to owning cash and less volatile bonds. And that's why, again, this chart really kind of lays that out. But we have to live with the volatility to get that extra return. And you're going to get a bear market like this once in a while. That's that risk reward trade-off that we benefit from by owning stocks as hard as it may be emotionally from time to time. So I think a lot of investors hear about risk reward trade-off, but they're not really sure what it means. But this is really what it means. It means you do get rewarded for owning stocks by getting paid a higher return, a significantly higher return over time than owning bonds or cash, but we have to live with that volatility. And that's, again, easier said than done, but this chart really lays it out really well. So let's touch on just a couple more questions here. And this one, Rafi, that came in is related to bonds. So a lot of people, and obviously the headlines, are focusing on the stock market, and obviously that's grabbing a lot of people grabbing the attention of a lot of people. But most people also own bonds, different type of bonds in their portfolio. What's happening with bonds? Should we be worried about corporate or municipal default rates if the economy continues to weaken?
Yeah, Dean, that's a great question. And, as I mentioned before, we have seen some small declines in bond prices, much less than on the stock side. And certainly when there's all this uncertainty about what's going to happen in the economy, then the question then becomes, well, how long is it going to take before, we start to see these impacts come up with municipal bond issuers where, they're seeing maybe their tax revenue collections go down? Are they going to be able to service their debt? Or on the corporate side, do companies have enough cash on hand to be able to get through this crisis and to continue to be able to also make good on their bond payments? And so, it's a very valid concern. Having said that, when we look at our client portfolios, the big focus of our client portfolios is on investment grade bonds, and a lot of that is in investment grade municipal bond issuers. And so a lot of that is in very high quality issuers, and so that provides some comfort there. And then in addition to that, having a really well diversified portfolio of bonds, and maybe some of the bond funds that we own have over thousands of bonds in them, is on the separate account manager side, there are fewer issuers but very high quality issuers. What that means is even if one of those bonds defaults, and that's really unlikely given how they are high quality issuers within that investment grade bond portion of the portfolio, that it has a less of an impact on the overall client portfolio. So that's another way where diversification really ends up helping you out.
Okay, last question, Raffia. There's so much gloom in the markets right now. What are a few things that we can be optimistic about?
Well, I think that, there's a world out there that we're going to be in after hopefully this this virus passes, and and once we're on the other side of it, I think there's a lot of things that we're going to learn from this unique situation that we're in, where many of us are working remotely. Maybe we're going to start to see increased productivity coming out of the virtual meeting format when people aren't having to travel. Maybe with more students staying home from college campuses, one of the things that we're going to see is one of the issues before was the high cost of higher education. Maybe with additional opportunities for remote learning, we learn newer ways of doing things. So I do have hope that, and I'm optimistic that things we're going to be stronger in some ways coming out of it on the other side. The economy was really healthy before this crisis hit. And so, provided we get the right stimulus measures in place and the right, support for the monetary policy system in place, hopefully we see a strong recovery after things start to, after the second quarter. Another opportunity is with, the rebalancing and being able to buy stocks at lower prices at this point in time, because when prices go down, expected returns go up, and that isn't a guarantee, but it's, and we can never promise anything when it comes to market returns, but that is something that we have historically seen.
And we certainly have had some clients who, have been putting some cash to work here as well, to, that they had some dry powder, if you will, and they're seeing this as a buying opportunity. So, as we talked about earlier, somebody is buying all those shares that are being sold as we've seen the downturn here. I'm going to add a few more. From a financial planning standpoint, there are some things that people can take advantage of right now. There are some opportunities. So one is mortgage rates. With the turmoil, interest rates have come down quite a bit. 30-year rates are down to 3%, 3.25%. I haven't looked at them recently, but they hit that at one point a few days ago. So people that have mortgages certainly may be able to refinance for much lower rates. Roth conversions might be another opportunity. So as most listeners will understand, when you take money out of your IRA or your 401k plan, eventually someone's got to pay income tax on that at ordinary rates. So whether you take it out in retirement, whether your children, let's say, inherit it eventually, someone's got to pay income tax on that at their ordinary income rate. So one opportunity here with the value of those IRAs being depressed, traditional IRAs, is potentially taking some money out of those funds, converting it over to a Roth IRA. Now you pay the income tax now, hopefully on a obviously lower amount, and then the recovery. Here's where the benefit comes. The recovery then, as the economy rebounds and the market rebounds, comes into the Roth IRA. The Roth IRA grows tax-free and eventually can be taken out tax-free. So for people that have significant IRAs, may feel like they don't really need to use all the money that's in those IRAs, depending on their tax bracket. That's a critical component here. Depending on their tax bracket, if it's low enough, it can make a lot of sense to convert some of that traditional IRA over to a Roth IRA, given these lower values. From an estate planning standpoint, for those with larger estates, gifting assets to trust for children or grandchildren, again, might be a good opportunity here. So again, if asset prices are depressed and they're lower, it might be a good time to get those assets out of your estate and have the rebound occur out of your estate, again, in either owned by kids or in trust for kids and grandchildren, and letting all that growth occur out of your estate. So that's the last question that we have. Raffia, anything else that you'd like to add?
No, I'm good. Thanks, Dean.
Well, thanks everybody for the time you've spent with us today. Thank you to our clients for the continued trust you have in us. For those clients who have specific questions about their personal situation, please contact your Wipfli financial advisor. For more general information on the topics we discussed here, today. Sorry, had to get that disclaimer up. For more general information on the topics we discussed here and lots of other investment and financial planning topics, be sure to visit our blog at onebite.com. That's onebite.com. I hope everybody enjoys the remainder of their day.